Thank you very much. This panel's about startups. The premise is what's the most promising startup, but we're going to talk about the scene more generally. And we're very lucky to have three people who are right at the coalface of the VC industry and fintech. I'd like to ask each of them if they could introduce themselves and perhaps talk very briefly about their company.
Greetings, I'm Pat Grady. I'm a partner with Sequoia Capital. We're a private investment partnership based out in the Bay Area. We've been in business for 40-some years, basically trying to help founders maximize the likelihood of making a dent in the universe. We've had a handful of successes with companies like Apple and Google and Oracle, or more recently, PayPal, Square, Stripe, a bunch of other companies in the fintech arena.
Nick, tell us about the Rockefeller connection.
Sure. So my name is Nick Beim. I'm a partner at Venrock here in New York. I have to acknowledge I'm a refugee of the financial services industry. I worked briefly at Goldman Sachs, so it's nice to see that the venture industry is now extremely excited about fintech in general. Venrock was one of the very first venture capital firms, started in the 1930s out of the Rockefeller family, effectively a Rockefeller family office that evolved into a venture capital firm. Initial investors in Apple and Intel and Gilead and Checkpoint, a lot of interesting companies. We've had fintech as a major focus. We have an office both in New York and in Silicon Valley, so we can see two big poles of that world. Companies like Dataminr and Personal Capital and Market Realist and several that have yet to be announced.
And I'm Amy Noyakis. I'm the president of the Anthemis Group. Anthemis is a London-based company that is one part early-stage venture capital investing and one part digital strategy in the financial services industry. And I, too, am a veteran of the incumbent world, having most recently been at Barclays. But I think what's quite unique about Anthemis, one part of us being based in London gives us a fairly unique perspective on the global markets, but also because we have a wonderful foothold in the startups that are emerging in this marketplace and have been doing this for quite some time. But we also have a really good sense of what the big banks and financial institutions are looking for and how they're looking at the industry, so we can create and identify theses around the gaps between the two.
Great. Well, we're going to try and rattle through as many subjects as we can. I'd like to start with a pretty broad question. The expression fintech covers a multitude of sins, from crowdfunding to payments to Bitcoin. Perhaps you could each define which bit of that vast canvas you think is most promising and interesting. And Amy, perhaps you could start.
Sure, yeah. I mean, I think it's fair to say that my partner Sean and I, when we started Anthemis, were fintech when fintech wasn't cool. When we started, I think it was fair to say there were probably about 10 companies that you could define as financial services technology to invest in. And now there's thousands around the world. And we look at financial services across a holistic number of industries, but what our specialty is and what we continue to focus on the market structurally changing businesses. So my colleagues in Silicon Valley do a phenomenal job of banking the kind of traditional e-commerce consumer plays, but we look at market structure across payments, retail banking, capital markets, risk, insurance, et cetera. For us, the most exciting place right now is probably one of the least exciting topics, but we're really excited about the insurance industry, in large part because of the really the entire business is based on data and analytics, and there's massive amounts of opportunity in that space for upheaval. But also, most insurance companies don't come with them with a significant amount of years and years of investment. I think a lot of folks will have looked at insurance companies and at the sector as a place where technology is relatively newfound for them. And so as such, they can approach the industry and the evolution in the industry with quite a greenfields approach. They don't have a ton of legacy systems, they don't have a ton of money already burnt, and it makes them pretty nimble and quite frankly, very interesting to watch.
I think if you look at the big trends of disruption in financial services, it really began with payments and has moved on to lending and wealth management. I think those are sort of three big themes where we see in wealth management more recently, and I know Adam is here today, that are where there's fundamental disruption going on and new models that are very difficult to compete with on user experience, cost, and speed. There are many areas of the financial services industry that I think have yet to be disrupted. I very much agree with Amy. Insurance is a big one. I think insurance brokerage is a particularly vulnerable space. Brokerages of all sorts, I think, just are very vulnerable. Insurance brokerages, I think, are particularly vulnerable. I think the the explosion of big data and its application to different fields, which is sort of a different view of opportunities, and real-time data in particular, I think very significant. I would say in venture capital, you do have certain theses of areas you pursue, but very often, and perhaps most often for the most promising opportunities, some entrepreneur will have thought so far ahead of you and will come with a great idea in an area that was non-obvious. And so I think there are going to be many of those non-obvious disruptions to come. What has changed and what's really interesting, I think one of the reasons we're all here, is Silicon Valley, New York, London, broad ecosystems where there's a lot of domain expertise in financial services have focused on fintech, and there's the brains that are focused on fintech, the money that's focused on fintech, the new disruptive models that are being experimented with are on a scale that we've never had before. And so we will see a lot more disruption and a lot more interesting companies and sectors in the years to come.
Yeah, Nick's point about non-obvious disruption is a really good one. We try to keep an open mind because you never know what you're going to find. And back to kind of the purpose of our partnership, which is to help founders make a dent in the universe. That presupposes a couple of conditions. One is a massive market, and two is an experience for the status quo that nobody really loves. Said differently, a bunch of dissatisfied customers. And I think that categorization applies to pretty much the full swath of financial services opportunities out there. Just to put it in context, there's maybe $2 trillion of market cap in the top 30 banks. The entire financial technology universe, if you add it up, is only about 100 billion of market cap. That includes private companies, and about half of that is PayPal. And so the disruptors in this sector are maybe 5% of the value of the incumbents, which if I compare it to other sectors that have been transformed by technology, Amazon today is about a 260 billion market cap company versus Walmart, which is maybe 180. So there are other sectors that are far, far, far further advanced. Said differently,
everything's a target.
Yeah, fintech, we're maybe in the second inning.
Right.
And I think in particular, there are companies that have structural advantages, like maybe Lending Club and Prosper, where they've decided that a marketplace is a fundamentally better mechanism for allocating capital than a balance sheet. There are companies that are able to actually bend the cost curve and change the basic economics of a business, whether that's Clover Health and with a Medicare Advantage insurance plan, or Lemonade, which is doing non-life insurance, or Vouch, which is doing consumer unsecured loans. And then there are companies that take what people perceive to be commodity businesses and squeeze 100% of the friction out of it. By doing so, get to ubiquity in record time, which gives them a cumulative data advantage that nobody else can replicate. And then on top of that proprietary data set, they start to do a lot of high value activities that people say, boy, I never saw that coming. And all of a sudden you have an incredibly powerful business model. So there are a bunch of different angles to approach.
And before we move on from this question, Bitcoin, gobbledygook, hype, or something that will make a big difference? Your very snappy answer, Amy.
We've been sort of bearish on Bitcoin from the beginning, cryptocurrencies in general. Our theory was if there is going to be a gold rush, we'd rather be in the picks and shovels business than in the actual gold mining. And so we made a really early bet on blockchain, which now, of course, is the buzzword of the day, making our first investment as far back, I think it's end of 2012. And I think that for us is how we'll spend our time looking at those cryptocurrencies, yeah.
Pat, you're a long-term optimist, I believe.
Yeah, short-term negative, long-term optimist. I think there are a bunch of very powerful reasons for why blockchain specifically, but also Bitcoin in particular, should exist. But there is not currently a forcing function in favor of the fact that it will exist. So it's a maybe as for whether or not it will exist. It's a yes as for whether or not it should exist.
Nick?
If I were a drug dealer, an Argentinian national or a Chinese national trying to move money offshore, I would love Bitcoin. I think it provides a quick solution to a problem that I have to a significant degree. That is a limited market and one that where regulators will be chasing you. I think the hype curve on Bitcoin went very high, and other than those applications, speculation seems to be a core application, which I think, again, is not very sustainable unless there's a lot else there. I do think blockchain generally is a fascinating area longer term, but I think that the excitement and hype has gotten far, far ahead of actual applications. And there's someone here, Wences Casares, who knows a lot more about Bitcoin than I do, one of the experts in the field, and so I look forward to hearing his thoughts too.
How many fintech startups are there? When you sit there looking at the potential universe of investments, how big is it?
Well, we cheated because we looked up the number before this panel. What was the number?
We came up with
6,000?
different numbers.
So yeah, 6,000.
I think the range was about 5,000% between the low estimate
Yeah,
and the
and the
high
high.
one. What's your rough sense of the size of?
So the size of the opportunity is massive, right? Many trillions of dollars of market cap, very little of which has been eaten thus
And number
far.
of companies.
Number of companies, there I mix. So I would be willing to bet that of those 5,000 or 6,000 companies that exist, 90% of them are out of business in the next 5 years. I think a lot of it is based on very incremental innovation. And as much as the narrative of disruption likes to say, look at these big, dumb, slow dinosaurs who are going to get killed by these smart, nimble, fast upstart, that's just not as true in financial services. Granted, regulation slows down a lot of the incumbents, but banks generally are very, very smart. JP Morgan has more developers, 20,000 plus, than almost any technology company on the planet. And anything that is incremental can and will be replicated. Now, there are also fintech startups that have massive structural advantages and huge wide open markets. And those might be able to withstand the test of time. But even in that case, you have to execute well across so many different disciplines. It's very hard to find a team that has the right blend of financial services DNA and technology DNA to be able to execute at scale across such a wide range of activities. So I think the death rate on fintech startups will be much higher than it is for most other tech startups.
I would agree and respectfully disagree on one point. I think you're absolutely right that there will be some winners in the incumbent financial institution space, but I don't know that it will be the obvious winners. My sense is that the key to success in this particular area, and quite frankly in any disruptive marketplace, is being nimble enough to be able to get it done. And I think that the banks that are looking at how they boil the ocean and fix every problem that they have with significant legacy investments and legacy problems, with significant red tape and regulatory scrutiny and fines levied against them that they're still trying to pull themselves out of from 2008, you leave a lot less room for innovation than you've ever had before. So even if you gave banks credit for being fully innovative vehicles, we're not looking at a world where it's easy for them. Even in the C-suite, the chairman and the CEOs of most big global organizations right now, they don't have a 10-year, 20-year outlook. They can't. They have to have a much more specific outlook for the challenges they have ahead of them. So I think that the banks that will emerge in this space will be the ones that need to the most, the ones that need to define themselves on this, on the back of digitization, and the ones that actually can use it to build market share in certain products and get it right in certain areas. But I completely agree that the number of financial services technology startups is probably overblown, and that we'll see a lot.
So the 5,000 or 6,000 will be eventually whittled down to a dozen or so. Nick, can you comment on this, but also talk about how much activity and how many companies there are outside of the US? To what extent is this really a global rather than American phenomenon?
Yeah, in response to your basic question, I think it all depends where you draw the line. If you draw the line at companies that have received venture backing, where there's a sufficiently serious team, focused business plan, that they've been able to raise meaningful money, I'd say it's maybe 1,000 or less. If you include, two guys in a living room or a garage, wherever they happen to live, I think this is an area that's excited a lot of passion. And while I do think most will go out of business, I think we, as Pat said, we're in the very early innings, and there will be thousands and thousands and thousands of more created. If you look at from a geographic perspective, there are a few major centers of fintech activity, and I think the big ones are Silicon Valley, Beijing and Shanghai, I think are the two biggest, and I think New York and London secondarily. New York and London have a lot of domain expertise, and I think that can do particularly well in the next innings. When I look at think about how the world will be different in 10 years in the fintech space, my mind first turns to China, because China, the large consumer internet companies in China, which are already the world's largest digital banks, and Baidu, Alibaba, Renren, Tencent are all going very aggressively into financial services, and they are creating the financial services industry in China. They don't have a sort of legacy industry or established industry to battle against. So when I think about the very big winners, my mind goes first to China, and I think there's just a huge amount of startup activity, so much venture capital available in China, and an opportunity to create companies of immense scale. So Lufax, the lending club of China, is bigger than the lending club of the US. They often apply business models that are working here and very well. So I think those are the major polls. Continental Europe has been a little bit slower. I think it's just more regulatory challenges.
Do you agree with that?
Yeah,
You're based in London.
Yeah, I definitely agree. I mean, I think that the lion's share of the companies that have been funded and the unicorns we've heard about have been largely coming from the US, but that's changing tremendously. And I think that we're incredibly bullish on Europe and sort of Israel as an example. We're seeing some great activity coming out of the markets there. And I think that the other thing to consider when you're looking at the financial services arena, you're always talking about a global marketplace. So one of the things that people forget to appreciate, that even if a company starts in North America and they're Seattle-based or Bay Area-based, and they have a marketplace relevance outside of the US, it's actually quite great in the early stages to get them there first and to have them test their product, break the product, fix the product in an environment that isn't so intense as it might be in the US. And so for a lot of some of the consumer insurance products we're seeing, or even in some of the lending space, it's actually quite the challenger bank space is too. It's nice to get them out of the US to sort of do a test run, even if they are US companies, and then bring them back. And same for European companies that want to go to the US. But we're seeing some significantly good companies, but also great entrepreneurs coming out of Europe.
Okay. Well, our panelists are in a difficult business. The most recent statistic I found was that there are 30,000 tech startups every year in the world, and of those 30,000, 10 will represent 97% of the value created. So you really have to have a focused approach, and I'm going to ask each of our panelists to pick a company which they think is particularly promising, and perhaps briefly just explain what it does and why they're excited about it. Pat, why don't you start?
Sure. So my choice would be Prosper Marketplace. Actually, the founder, Chris Larsen, was on the last panel. This was the company he founded before he got into the digital currency business. So Prosper is a peer-to-peer lending marketplace. The fundamental premise is that a marketplace is a better mechanism to allocate capital than a bank's balance sheet. They have several advantages that are structural in nature, most of which relate to the matching mechanism between the asset and liability side of the marketplace, the fact that it is a technology business, which gives it fundamentally lower cost infrastructure and an ability to move faster, and the extensible nature of the platform, because at the end of the day, banks are basically assets and liabilities, and in the context of a peer-to-peer marketplace, that just means the borrower side and the investor side. Spectacular team, 200 million-ish of revenue, growing north of 100% year over year, so they have some scale to the business. And I think most importantly, the name is Prosper, the brand stands for consumer prosperity. It is a mission that people can get behind, and as a result, they're able to hire spectacular talent and able to extend the reach of financial services into more and more pockets of the economy, which is an important thing.
Okay. Amy.
Well, I look at it in two places. I think in the category definers, the ones that have been around a little longer, I think our favorites in our portfolio continue to be Betterment and Eris Industries in the blockchain space. But I think from the sort of folks that are just coming out of the gate, it's often like picking your favorite child. But I think one that we're quite bullish on is a company called Trove out of Seattle. And Trove is essentially a treasure chest to collect all of your non-financial assets. And it's a wonderful insurance product, not only for the individual, it's creating a community of everything from artwork to cars to jewelry to real estate, but also from an insurance premium perspective, you can imagine it's taking a different approach to the appraisal market, which has proved to be quite challenging and quite inefficient. So we're quite excited about that.
Nick.
I would say one of the most interesting companies, and it's ended up becoming the fastest growing SaaS company ever, because it played a very cool trick with its business model that I think can be replicated elsewhere in fintech, is a company called Zenefits. So Zenefits started as a company offering benefits management software to small and mid-sized businesses because it is an immense headache for them. And but the innovation in their business model was, rather than charging a SaaS fee, which is what 99.9% of SaaS companies do, they decided to make the software free, and for any of their customers who wanted to opt in, they would become the health insurance broker of record. And that is a beautiful business. It is a very substantial annuity business, in this particular case, protected by law, established by law. And the innovation, and they've just grown very quickly. They're making far more money per customer with that business model than they would have by charging a SaaS fee. And that's why they've grown so quickly. And it's a $20 to $40 billion market, depending on how you measure it. They're growing very fast. I think they're 2.5 years old, and they'll be at a $100 million run rate in a couple of months. So that's public information. Very successful company. And it points to, I think, a really interesting innovation that I hope to find more of, which is finding a low-value revenue stream. So in this case, the revenue stream of health insurance brokers, which to companies were sort of like a help desk that no one really ever called, or people called very infrequently, although they were paying them an enormous amount of money, and adding value to that by giving software away for free and giving this big suite of benefits management away for free. Square has done something a bit analogous. It's got a point of sale system, but part of the purpose of its business model is to take over the payment processing stream, and I think if you talk to the merchants, they think, well, I don't care who does this, Square can do this, but that's actually a very significant revenue stream over time. And I think just ossified and the infrastructure of the financial services industry are a lot of these commoditized low-value revenue streams where you can add a lot of value with creative innovations, sometimes in an orthogonal manner. So that's a theme that excites me.
Excellent. We've got time for some questions. I think there should be a roving microphone, and there's one there. Does anyone have any questions for the panel? We might try and take 2 or 3 at once just to pack them in. There's a gentleman there with his hand raised. Perhaps he could go first.
Good morning. I happen to have a fintech startup down in Miami, and we do business funding online. So I'm curious to what everyone on the panel thinks of. When you look at a startup, you look at a company, what are the most important attributes? Is it a proprietary business model? Is it industry experience? Is it a management team? Is it eventual profitability? What are the key things or number one thing that you look for in a startup?
Great. Do we have another question? Is there anyone who would... Sorry, I can't see. There's a gentleman at the back there. Perhaps we could take...
Thank you. Hi, you mentioned London, Beijing first. Valley and Beijing first, London and New York second. Is proximity to Wall Street a benefit or a detriment to aspiring fintech companies? What do you think?
Right. Any more? Another question? Gentleman here. Sorry, I'm making our microphone man run. If we could just do that one as well, and I think we'll save some time.
Hi. There seems to be a huge amount of talk about non-wealth management fintech companies, which is very inspiring. But here in New York, everyone seems to talk about wealth management companies in fintech, and that seems to be where the majority of the investment is going. I'd love to know what the panel thinks outside of Betterment. Who are the winners in that, and will they all just be snapped up in the next recession?
Excellent. Okay. First of all, so what's the magic sauce you look for in a startup? Who would like to take that one?
So we're pretty simplistic about this. The number one thing is the founder's ability to articulate the business. And wrapped within that are all the other aspects of an investment. But if the founder can articulate in one sentence why what he or she is doing is important, customers will sign on, employees will sign on, and the world will move in favor of the company.
Are you able to articulate in one line what you're doing? Okay, good. You're very welcome to do that right now if you want.
We see opportunity in small businesses that other people can't.
Good. Okay, thank you. Magic sauce, anything more to add on that?
I would add 2 things. I would maybe extend that one. I very much agree. So I'd say 70% of any investment we make is in the team. I think their ability to articulate a vision, and then very strong confidence they'll be able to execute. It takes a certain willpower to create something out of nothing, a certain chutzpah, a certain ability to attract talent, inspire customers, inspire employees, inspire investors. Some people have it, some people don't. You may have domain expertise. There are a lot of other dimensions that you look for in founders, but if the team can articulate their vision and you have strong belief can execute it, that's more than half the ballgame. I think the 2 other big things we look for are differentiation. So in small business lending, for example, to the extent you can do it better, that's really interesting. Understanding how and how scalable and protectable is that is very interesting. And then the last one, and I think we all would agree on this, is just market size. And one of the beautiful things about fintech is the markets are just immense. So 3 big things.
I mean, I would agree with both of you. I mean, certainly it's people, people, people first, and certainly if you're early stage, that has to be how you take your lead. For us, we put people first, and then it's market size and market opportunity second, and then product third, and in that order, because a lot of times in the financial services space, you can get it right identifying the problem, and you can have a strategy to articulate how you're going to solve that problem, but you might not always be spot on the way that product is going to accomplish that. And so we think that there's a lot of room in the early stages to get that wrong. And it's not for us a deal breaker if you've got product wrong, but you have to have the market appetite, the market opportunity, and you have to have a team that has a vision.
Okay. Is proximity to the dark heart of Wall Street a good thing or a bad thing?
Most valuable fintech company out there was not founded in New York.
Right.
Yeah.
PayPal, Silicon Valley. Not an ounce of financial services DNA in the building.
Nick, you're based in New York.
Well, I'd say the second most valuable one, Bloomberg was. So New York does have some things going for it. I would answer the question in a couple of ways. So one is, fintech is a really interesting area for startups because you really do need some domain expertise in the industry and where the vulnerability points are, how you're going to have a differentiated model, and why it will win. And so if you look at a lot of the best fintech entrepreneurs, they really do understand these markets well. And I think New York is teeming with fintech expertise, and the technology has gotten relatively easy for the first few innings. So to try a new service out, obviously to scale and to improve your product takes a lot of engineering and product expertise. But I am very bullish. I'm talking about my home team here, but independent of that, trying to be independent, I am very bullish on the future of New York. Just looking at the caliber of talent, looking at new opportunities. To the question specifically that was asked about what areas they're focused on. So Betterment has obviously been an interesting company that has done well in New York, but I think there's so many. So as I look at the fintech world and I start with kind of who's doing well, there's another company, Dataminr, which is in the real-time information world, so taking a big bite out of Bloomberg and Thomson Reuters business because it can discover information faster and it can discover unknown unknowns that would never have seen the light of day, and it uses social data and algorithms to do that. They just raised $130 million, very significant company. I think Oscar is trying to innovate on health insurance. So I think there's a broad range in that, and that will continue. And I would expect, so I think Silicon Valley and Beijing and Shanghai will continue to produce the biggest winners and the highest volume. But I think New York will have far more fintech winners in the next decade, $500 million plus in value.
And for us, I mean, the number one benefit of not being in New York or in the Valley, quite frankly, is that we are isolated from the noise to some degree. And I think as an investor, but also in financial services, we all start to be convinced by our own stories pretty quickly. And so when you kind of separate yourself from where those conversations are happening, you have a better chance at just differentiating signal from noise. And so we think as an investor, that's fantastic to be outside of the fray. From a company perspective, the challenges really are with valuations. And there are still there's a significant difference between the valuations that you're getting out of North American companies than you're going to get in some parts of Europe. So it's a bit of a challenge, but I think for an early stage company, it's kind of great to not be here first and to have a chance to actually get it right before you come here. So I think there's lots of benefits for being outside of the fray.
Would one of you like to take the question on wealth management? Any volunteers?
I mean, we were one of the first investors in Betterment, so I have a bias, of course. But I think that what Betterment did and what a lot of the early robo-advisors did is they defined a category. And by defining a category, they created a business. And by creating a business, they created equity, right? They have a massive new line to sort of put their flag in. The challenge, though, is that we're not looking at robo-advising or wealth management right now as necessarily a great place to invest. It feels a little like not the new idea. And I think in that case, you've got to look at these as sort of the longer term game for these companies. There are a lot of financial institutions, and I think you guys said it earlier when we talked about Charles Schwab and some of the products that they've created in-house. I mean, there are a lot of incumbents that will be able to create some of these similar robo-advisors and others that will accurately identify those they want to purchase. So I don't think the game is over in wealth management, but I think it's going to come into a different era very shortly.
I might jump in on wealth management as well. We were investors in Personal Capital, which is one of the players in the field. And I think it's a fantastic example of many things to come in that it is putting aside the higher touch wealth management at the higher end of the of the market. It is just a better solution. It is transparent with respect to performance. It's transparent with respect to fees and taxes. It has much lower fees and a much better user interface. And I think a lot of wealth management has been a commodity product that's been sold with, significant margin to the seller, and it was just waiting to be disrupted. So I think technology really can provide a better solution, not for the entire market, but for particularly the lower ends of it. It's a tough business model in that acquiring new customers is very expensive. And so I think in part for that reason, these are all great businesses and they'll do well, but that's the hard part. I do think most of them will be bought up by larger financial institutions.
Okay, well, we're going to close by asking each of our panelists to make a controversial prediction about fintech. Again, we're a wee bit short of time, so keep it snappy. Pat, why don't you go first?
Sure. So there are maybe 100 million people, roughly half the adult population in the US, that are not touched by the traditional financial services institutions today. My prediction is that in 20 years, the reach of financial services will be twice what it is today, meaning everybody will have access to it. But the value, both the market cap and the share of GDP, will be half of what it is today, because it is opacity that sustains those profit margins, and technology and transparency will democratize that. And while the quantity will go up, the price will go down, and there will be a net compression in the value of the sector.
Excellent.
The most disruptive player in the insurance market over the next 20 years will be Google.
Can you elaborate?
Yeah, so Google has astonishingly granular information on so many parts of our lives, and it has astonishing global reach, desktop and mobile. It's put its toe in the water with its new Auto Insurance Compare product and has been actively thinking about insurance. I think, as Larry Ellison said about Google, overstating things colorfully but helpfully, is it's been primarily a one-trick pony, but it was a hell of a trick. I think their AdWords product was the best marketing product the world's ever seen, and it has other products, but that's really the core of its business. I think the creation of Alphabet and all of their new companies signal that they are looking for big new markets. They've been testing with the sort of self-driving cars, potentially Uber-type models, but I think insurance, they have an advantage with their data that is just extremely difficult to compete with.
Amy, your prediction.
I'm going to look at it from a different perspective and focus a bit on talent. There's been a lot of talk in the industry, in the tech industry in general, about the lack of diversity and gender and other diversity in the tech community. And I'm going to make a prediction that in financial services technology, you're going to see a significantly more diverse and certainly on the gender side, more robust group of women founders than you'd see in any other tech startup. And I believe this truly because I think that the structural impediment of being able to change the incumbent financial institutions' models for how you support and help grow women in that workforce, it's just taken so long and it's not going fast enough. And I think you're going to see a lot of mid-career women jumping ship and starting their own companies and doing it in the financial services world.
Well, I think our panelists have been, if I can paraphrase you all, you seem to be believers that a very big disruption is taking place, but also have a bit of a note of caution about some of the companies and a realistic sense of how easy or hard it might be to make money. We're going to have a coffee break now, and I think the next session begins at 11:15, if you could return here. And could I thank all three of our panelists very much indeed. Thank you.